Welcome to the Intermarket Analysis video update. This is a video that's done once a week, and I'll go over the different areas that are covered, but it's being prepared for Monday, March 10th. The first area that I go over is valuation. We look backwards at earnings that have already come out and compare them to the current price of the S&P. Then we look at forward earnings. That's what the stock market uses to see are we overvalued at that point or fairly priced. Then I go through a pretty extensive look at growth versus value. And as I record this on March 10th, we're dealing with that right now. When growth is outperforming value, the market is more positive and we're usually going up. What we've been seeing lately is a more defensive shift, going from growth to value over to value to growth. We're keeping an eye on that. We're not seeing any long-term changes with the trends right now, but we just want to watch that. Also, we do kind of a short section here on inflation. Then we look at other markets that we really don't pay attention to, but I look at once a week just to see what's going on that are outside of the stock market. Then we look at the 11 sectors that make up the S&P 500 and look at the sector by itself and then compare it to how it's performing with the S&P 500. Then we look at some other indexes. Some of these are other stock indexes, some of them are different sectors, just to see what's happening throughout the market. Then we look at some correlations. We look at how certain asset classes are correlating with each other. That sometimes can give us some insight. And then I finish up by looking at some very long-term trends. At the end, however, this is new to me here. I have a list of those things that are positive and then those things that are negative. Okay, so let's look at valuation. First of all, we look backwards and we use a thing called the PE ratio that's based on a 10, 15, 20-point scale. When we're above 20, which is the red dashed line, this is about where we should be according to a PE ratio of 20. Well, you can see the black line's way up here. And even though we've been under pressure lately, we're still very far away from this red dashed line. In fact, I blow it up down here just to measure the distance between the two. So looking on a historical basis, we continue to be overextended to the upside or expensive, but we've been that way now for a number of years. This is another look at that same thing, and then different events that have happened going back to 1980. This is a variation of the PE ratio where it takes a more smooth approach with earnings. It's called the Shiller PE ratio. It's coming in at 36.34 right now, and you can see that it's higher than it's been in the past, and this goes all the way back into the 1800s. Well, we can also look at the median and the mean, which is between 16 and 17. That's where it's been at for the last few years. So we're double now as far as looking expensive according to this chart. Also, some standard deviation lines are plotted on this chart. When we get above the standard deviation of 1, that means that we are expensive. And these are a little more dynamic. They change as the Shiller PE ratio changes. This also suggests that we are expensive. Then we look at forward PE ratios. This is what the market works off of. Now you can see we're coming down here. This is the magnificent 8 or 7 or whatever you want to call them. It's been coming down, but we're still getting a very high reading, well above that 20 level at 25.9. The one that I focus on the most is the red line. That's the S&P 500. It's coming down too, but it's still above 20 at 20.8. Then more in the mid-range for the PE ratio, we have the mid caps and the small caps. The mid caps are coming in right at 15, so they're fairly priced right now. And the small caps, which have also been under pressure lately, are coming in at 14.9. And we look at growth versus value. First, we look at growth all by itself, where it's in an uptrend, but you can see it's really been coming down lately as growth has been under pressure. Value is also in an uptrend, and it hasn't really been screaming to the upside, but it hasn't been falling down the way growth has. And that's why we're seeing a real shift in our growth to value ratios right now. Then we do some ratios by themselves here, just looking at growth versus value, showing how growth has been outperforming but pulling back. Here's an inverse of that same ratio, showing how value's been underperforming but bouncing back lately. And this is what we're keeping an eye on. If this was to continue and these trends were to change, that might mean that the market is becoming more defensive. And we've been seeing that now for the last few weeks, and to a degree, going back to the beginning of 2025. Then we look at another ratio here of growth to value, where growth has been pretty choppy lately, but we're in an uptrend where growth has been outperforming, but we've fallen back down recently. Here's an inverse of that, showing how value was underperforming, but now bouncing back up. Another look here showing how growth has been strong, but pulling back. And then another inverted chart, how value was underperforming, but showing some strength. And then looking here again at growth, where it's been showing some recent weakness lately. So we're just watching this because this can change the overall tone of the market. Then we look at a growth versus value ETF, and this is actually dropping down below the rainbow. This is showing some weakness. This is coming up out of the rainbow when we look at value versus growth. And then we look at just the small cap growth to value, where it's in an uptrend, but really showing some weakness now, actually dropping under its 200-day moving average with this ratio. The mega caps also now dropping under their 200-day moving average. And even the S&P has been showing some weakness after showing some strength. So we're concerned about this, but it hasn't actually officially changed yet. We look at other things as well, but I always focus on growth versus value. And if we see value starting to outperform, we get a little bit nervous about that. Now, value can do well, but we need growth to do even better. And that's not what's been happening lately, going back to the early to mid part of February. Then we keep an eye on inflation. This is a monthly chart of the CRB index, which are commodities. We're still above the moving average, but it hasn't really been going up all that much. And then we look at a ratio of inflation to deflation, where for the most part, this still is going down, meaning that inflation, according to the long-term chart, is not really a problem, even though we're hearing lots of murmuring about inflation fears in the market right now. Then we look at commodities. This is a daily chart where it is in an uptrend. And some of the strength here has been because of the tariffs and executive orders and uncertainty about Doge and all the cuts and what's that going to do to the economy. And sometimes commodities will end up doing better, even though they've been pulling back lately. We look at the Baltic Dry Index. It's been coming back up, but it's still in a downtrend. This is another inflation gauge that we follow. When it's going up, we get a little bit more concerned. Then inflation expectations have actually been coming down. This is a weekly chart, and you can see since the beginning of 2025, this has actually been falling. Then we look at other markets. Aluminum, which is still in a downtrend here, that's not inflationary. Corn, which is now in an uptrend, that could be inflationary, and that's food. Wheat is also still in a downtrend, but it has been bouncing back up lately. And then fertilizer, which is starting to go up, that could be inflationary. Oil, which has actually been going down, that's not inflationary. Then we look at a ratio of gold to oil, and it's not that gold has been doing great, it's just oil has been going down, and that's why we're seeing this ratio going up. Then we look at a correlation between the 10-year yield, that's interest rates, and oil. And you can see that there's a pretty strong correlation between the two. But lately, we've been seeing oil going back up here on this chart, where the 10-year yield had been dropping and now is starting to go back up. And we're pretty much neutral right now with this correlation. We keep an eye on gas, which is just starting to resume an uptrend here after it had been really declining. Heating oil is still in a downtrend, but it's showing signs of bouncing up at times. Natural gas is now in an uptrend after it had been in a pretty severe downtrend. Diesel, which has been falling down, and overall, it's in an overall downtrend here. Lumber, which is in an uptrend, that could be inflationary. Copper, now this we use not only for inflation purposes, but as a barometer of the economy. We're just starting to see a cross here. The 50-period moving average is going above the 200. That's showing a new uptrend. Now, if the economy was getting ready to fall apart, we wouldn't see copper doing as well as it has been lately. We look at a copper to gold ratio, which copper's been underperforming, but it has been bouncing back and showing some strength, where gold has just been kind of going sideways for the last week or so. A long-term chart here, the black line, that's the copper to gold ratio. And then to give it more context, we can see lately how interest rates have been coming down with the 2-year yield and the 10-year yield. Gold, when we look at the ETF all by itself, it's in an uptrend, but it's been chopping along here. And silver is also still in an uptrend. And we look at the closing price for gold on top, the closing price for silver in the middle, and we look at the correlation between the two, and it's weakening a little bit, but they're having a strong tendency to go in the same direction at the same time. We look at a gold to silver ratio here. When it's going up, that means gold's outperforming. When this is going down, that means silver's outperforming. And then we compare that to the US dollar down here, where the dollar's just been getting hammered lately. And I'll have some other charts to show you of that here. But we're pretty much neutral with the relationship between the top chart and the middle chart. So we're seeing something kind of strange going on right now when it applies to the dollar. It had been really strong in the wake of all these tariffs being announced. Well, now the tariffs are kicking in, and we're seeing a lot of weakness in the dollar currently. Here's the dollar by itself, where it's still in an uptrend, but it really fell. Just a week ago, when I did this video, we were up into the 107s. Now we're dropping all the way down into the 103s. And then we keep an eye on the euro and then compare that to the US dollar index. And these are pretty much a mirror image of each other. We also plot the Japanese yen here with the euro and then the dollar. And then we do some studies. I break it out here with the euro to the dollar, where it's in a downtrend, but you can see how it's really been surging lately. And the Japanese yen is still in a downtrend as well, but also really going up lately against the dollar. And the British pound in a downtrend, but really moving up lately. Then some other indexes. This is the weighted version of the S&P 500. That's the regular index. And then we compare it to an equal weight version. That's the red line here. And when the red line's underneath the bar chart, that means that the equal weight version is underperforming. We would like to see these two right on top of each other. Then we look at a ratio between the equal weight and the S&P 500. Lately, this has been bouncing back up, and this could be part of that shift that we're seeing from growth over to value, as the rest of the S&P has actually been outperforming the bigger stocks in the S&P lately. We'll keep an eye on this and see if this ratio keeps going up, or that would be more negative for the market. If this keeps going down, that means that the big stocks are coming back in and seeing more favor. And we look at stocks to commodities. This is actually showing a downtrend now. We had been in a pretty solid uptrend, but now this is starting to come down as commodities have been outperforming stocks, which is what we show on the next chart, an inverse here, where this is now showing that commodities are in an uptrend when we do a ratio with stocks. And we look at the NASDAQ 100 and the S&P 500. The S&P has been holding up a little bit better, so we're showing this ratio actually going down. When the NASDAQ 100 is outperforming the S&P, that's when the market is more positive. And the S&P 100 is now in a downtrend compared to the S&P 500, and this is a little bit of a concern to us. And we look at the NASDAQ versus the S&P 500. The NASDAQ had been outperforming, but lately it's been underperforming because that's more tech, where the S&P not only has growth but value at the same time, and that's why we're seeing this ratio coming down. The NASDAQ 100 is now starting to outperform the NASDAQ. Now, both have been under pressure lately. But you can see here, when we went into that really strong up move almost a year ago now, the NASDAQ 100 was leading the way higher. Then we started to drop down as we came into the rest of 2024. Now we're starting to go back up. But it's not that the NASDAQ 100 is strong. It's just holding up better right now than the NASDAQ itself. Then we look at the mega caps, the really big stocks, and compare them with the equal weight. It's really coming down right now. We're watching this to see if there's a shift that's actually taking place. And then we look at small caps, and it's not that small caps have been doing all that bad or all that well, and it's not that the S&P has been doing all that well. It's just that the small caps are doing worse right now. Here's another look. The red line here, that's the small cap to S&P ratio, and then the blue line is the S&P itself. Mega cap growth, seeing some weakness, coming back down to the 200-day moving average now. We haven't seen that in quite a while. Robotics and AI ETF coming down, falling below the rainbow by itself, but it's actually holding up a little bit better when we do a ratio with the tech sector. Then the Dow Jones Composite Average coming down to its 200-day moving average. Then we look at just some other stocks and compare them with the S&P. Now, when I look at this, and I use this in the daily video, I say this is positive because the S&P is still above the moving average. But if you look at the other indexes, the NYSE common stock, the mid caps, and the small caps, they're all underneath the moving average. And we look at traditional Dow theory, which uses the Dow and the transports. The transports have really been falling more, even though the Dow hasn't been holding up all that well, but it's been holding up better than some of the other indexes. And the utilities have pretty much been going sideways lately. And when this is going up, that means the Dow is outperforming the transports. And here's the transports by themselves. They pretty much have been sideways now for quite some time. We do a ratio between the transports and the S&P. Overall, it's been declining, but bouncing back up so far in March. Look at the correlation between the S&P and the transports, and it's still pretty strong. And then new Dow theory, instead of using the Dow, we use the S&P 500, which has been under pressure. Instead of using the transports, we use the NASDAQ, which has also been under pressure. And we break that out a little further, and we see that the equal weight S&P 500 is coming down, but it's been holding up a little bit better, where the equal weight version of the QQQs, which did set a recent all-time high, where the equal weight S&P did not. That's a negative divergence. We're actually seeing the Qs now with the equal weight version declining with a little bit more conviction. Then low volatility stocks. These are the stocks that folks favor when it looks like we're getting more defensive. Now, this has been in an uptrend. It was in an uptrend for all of 2024. We pulled back and now we're doing quite well here. Where we get some insight is when we do a ratio of the low volatility ETF to the S&P, and it's in a downtrend. You see how it's been spiking up lately? And this is what we're keeping an eye on here. The Wilshire 5000, which is a broad market index, it actually fell underneath its 200-day moving average on Thursday, but it was able to get that back on Friday. Then another total US stock ETF also testing its 200-day moving average. The FANG index just barely above its 200-day moving average. But when we look at this longer term trend line, we broke below it. And so this is some of the weakness that we've been seeing lately. ARC came all the way down below its 50-day moving average and is now testing its 200-day moving average. And then we look at the world stocks taking out US stocks. They're actually doing better. They're holding up and we're starting to resume an uptrend here. And then we do a ratio. We compare the S&P to the world ETF that we just saw. This is really showing how US stocks are now underperforming. And then we look at another measure here. This is longer term, a monthly chart of stocks in Europe, Australia, Asia, and the Far East, and then compare them to US stocks. Coming down lately, but we're still above this long-term moving average. We're also seeing the momentum oscillator declining. This is showing that US stocks are under pressure right now. And then we look at a ratio between the energy sector and the tech sector. We've been going sideways for most of 2025 now, but overall, when this is going down, that means energy is underperforming. Well, it's been starting to bounce back up. That's seen more of a defensive move. Then growth versus more conservative bonds, it had been really outperforming and it's still in an uptrend, coming all the way down to the 200-day moving average with this ratio. Then we look at the tech sector, the 10-year yield. Actually, we're starting to show where the tech sector is underperforming interest rates. This is that same thing showing how interest rates are starting to outperform the tech sector. Discretionary versus staples, really seeing discretionary underperforming lately, and really seeing staples outperforming discretionary. And I go over this in the daily video each day. And then gold to the S&P. And it's not that gold has been doing all that great. It's that the S&P has been going down. And so that's why we're seeing this ratio going up. And then gold to the dollar, kind of the same thing here. The recent weakness in the dollar is showing this ratio going up. High leverage loans, we're keeping an eye on this. We've been above the 50-day moving average for quite some time. This is another barometer that you can use to gauge the economy because these are really risky loans. Well, we're seeing some weakness here, coming back down and testing its 50-day moving average, but not seeing anything really weak yet, but it has been showing some weakness. The NYC composite actually has been holding up better. It's below its 50-day moving average and not really testing its 200-day moving average. Now, the NYSE composite does have a lot of value components, and that might be why this is holding up. All stocks, which looks at US as well as international stocks, coming down a little bit below the 50-period moving average, but holding up better than some of the other indexes that we've been seeing. Emerging markets are in an uptrend, and this might be attractive to some folks, especially if we see the dollar continue to decline. And then the Japanese Nikkei, it's just been chopping around here, but it's also been under some weakness lately. Bitcoin, which cannot seem to stay above 100,000, is actually coming down and testing its 200-day moving average. And we look at the S&P and home builders, not really seeing all that much of a change here in the discrepancy in the correlation here. It's pretty much neutral right now. Usually they have a real high degree of correlation. If this drops way down here, that's when we get quite concerned. And then we look at the micro caps, really small stocks. They're actually dropping below their 200-day moving average, showing some weakness there. Then we look at stocks in China. This is a long-term oscillator. They've been going up, but could be starting to stall out, rolling over with emerging markets, rolling over in Europe. Japan's been looking pretty strong, but we're actually in a downtrend here in the US using this oscillator. Then we look at the intermarket analysis chart, where going back to the beginning of 2025, gold has been doing the best, followed by the price of bonds, which were negative for 2023 and 2024. And then the black line are stocks, which are negative. The green line is the dollar, and the red line is oil. We look at the semiconductors. This is the SOX index. It's in a downtrend and showing some weakness. And we keep an eye on this, and I have a number of different ways to look at the semiconductors. And we're seeing pretty much weakness across the board right now, which is a concern because if the semis do well, then tech does well. And if tech does well, the NASDAQ 100 does well. And if the NASDAQ 100 does well, the S&P 500 does well. Here is the SMH semiconductor ETF. We're just about ready to see a death cross here with this. This is the semiconductor, the same ETF that I just showed you, but we're falling further below the rainbow. And you can see these lines are really starting to bunch up right now. Then here's another ETF. This is AI and tech. I don't have it with the ratio with the tech sector. This is just showing it by itself, where this is looking a little more positive. We're coming down and actually testing the 200-day moving average. This is all the rage right now with all the AI things coming to the market. We'll see if this 200-day moving average ends up holding. Then we do a ratio of semis to tech. It's been chopping sideways lately for the most part. Then we do another ratio of semiconductors to the Dow. This continues to go down, and that's a little bit of a concern. And then the Dow Jones Semiconductor Index, still in an uptrend, but falling below its 200-day moving average. So we're seeing across the board weakness here. And then small caps to tech, just chopping around because small caps have not been doing well. Tech's been under pressure, so we're not really seeing a lot of conviction right now. Then we look at another global longer-term chart monthly was U.S. stocks versus stocks in Europe, Australia, Asia, and the Far East. Showing some weakness here. The momentum is also starting to go down. This is actually from a week ago. Okay. Then we look at the price of bonds, which were starting to go back up and interest rates were coming down. But over the last few sessions, bond prices have been coming back down. But we're holding up. This is the total bond ETF, which is coming up above its 50-day moving average, still in an uptrend. The Pring World Bond Index, though, is in a downtrend, but it has been bouncing back up lately. We look at a long-term monthly chart of a stock-to-bond ratio, where when this is going up, that means stocks are outperforming, but lately they've been pulling back. And then another daily chart of a bond-to-stock ratio, where it's starting to come up right to this red line, which is the 200-day moving average. Then high-yield corporate bonds, which are junk bonds, these are actually holding up fairly well recently, above their 50-day moving average. Where we're seeing some weakness, though, is in corporate bonds. We actually saw a recent death cross, but then after that happened, corporate bonds have been showing some improvement. Then we look at a ratio between risky junk bonds and more conservative government bonds, which are safe. We came all the way down to the end of the rainbow, the bottom end here. Now we're starting to bounce back up. We'll see if we see more of a shift with this ratio. Then a stock to bond correlation, pretty much neutral right now. And then the corporate bond index, also under some pressure right now, showing a recent death cross. Then the 10-year yield, not really any insight here. These are Fibonacci retracement levels, and we're not near any of those lines. This is a long-term chart of the 10-year yield where we've been establishing a higher range since the whole COVID crash. And then here's another fib retracement study with the 30-year yield, but we're in between all of these retracement levels. Then we compare stocks with the 10-year yield. We're actually showing where stocks are beginning to underperform. Junk bonds, which are holding up fairly well. They haven't even come down to their 50-day moving average, and they tend to follow the stock market. Then we look at a ratio here, junk bonds to government bonds, where junk bonds are still outperforming, even though they've been pulling back recently. Then here's a daily chart of the yields, where we've been coming down with interest rates, but over the last few sessions, they've been going back up. Then we're keeping an eye on this weekly chart of international 10-year yields in the US, UK, Japan, and Germany. What we're concerned about is this red line in Japan. If this keeps going up, is that going to cause a problem similar to what we saw last summer? We look at the volatility of bonds on top. That's measured by the MOVE index. The volatility of stocks, that's measured by the VIX. And we see that there's a pretty high correlation between the two. As bonds have been going up, stocks have been going down. And so we're seeing an increase in volatility of both of these indexes. Then we look at some ratios of stocks to bonds, where when this is going down, that means bonds are underperforming stocks, but you can see how lately it's really been coming back up. And we look at the S&P 500 and compare it to short-term bonds. We're coming down to the bottom end of this rainbow here. And then another broad market measure, S&P 1500 to short-term bonds, also coming down to the bottom end of the rainbow, where it's kind of like we're getting to a point where something's going to have to happen pretty soon. Either we're going to bounce up out of these bottom end rainbows that we're seeing, or we're going to fall through it. And that's going to suggest a change in the overall climate of the market. Another broad market measure with further out bonds also coming down to the bottom end of the rainbow. The tech sector to 3 to 7 year bonds actually falling below the rainbow, showing more weakness with the tech sector. And then we look at the 30-year price of the bond on top, where it's been in a downtrend and the moving average is still going down. But when we do a ratio of bonds to commodities, bonds, even though the bonds have been under pressure and in a downtrend, they were still outperforming commodities longer term. That could be starting to change here as we're seeing this ratio roll over. Now we look at the different sectors, and similar to what I did at the beginning, where we look at the PE ratio for the S&P 500, this is a current chart of what are the different sectors, the 11 sectors of the S&P. Some of these are overvalued, they're over 20. Some of these are right at 20, like materials. Some of them are more the more defensive areas. They actually are under 20, with energy right down at 14. It's more fairly priced. And so you might want to look at this, see where we're at right now, and then look at different ways of measuring that. And we look at just the materials sector by itself, which is in a downtrend right now. And then we compare it to the S&P, showing how the materials are underperforming, but bouncing back lately. Communication, this is a big growth area, but it's been pulling back and falling under its 50-day moving average, but it's still outperforming the S&P. It's been holding up better. So this is still one of the more positive aspects of the market. You can see how the S&P has been coming down, but the communication to S&P ratio has been going up. Energy, which is just kind of chopping along here. It can't decide what kind of a trend it wants to be in. But when we compare it to the S&P, it's been bouncing back up lately, but still underperforming longer term. The financials. Now, this has been a stronger area lately, but we've been seeing some weakness here. We want to keep an eye on this area too. We've actually fallen under the 50-period moving average, and we're coming down, but still on a ratio basis. The financial sector is showing some weakness, but still it's looking better longer term. The industrials coming down and testing their 200-day moving average, and actually it's still in a downtrend, but showing some recent weakness now when compared to the recent strength compared to the S&P. And then the tech sector. This is the real growth area, and we're falling underneath the 200-day moving average, and we're just kind of going sideways to down when we compare it to the S&P. Staples. This is defensive, looking solid all by itself and in a downtrend, but really coming back lately. This is what we've been keeping an eye on. Real estate, still in an uptrend above its 50-day moving average. And lately it's been bouncing back up as interest rates have been coming back down, but it's still in a longer term downtrend. Utilities coming down and testing their 200-day moving average with the sector itself and just kind of chopping sideways when compared to the S&P 500. And we're kind of chopping sideways here. This is an inverse of what I just showed. This is S&P to utilities. The other one was utilities to S&P. We're not really seeing any conviction right now. And healthcare, which is in a downtrend, but coming back and showing some strength recently, this is more defensive and bouncing back up when compared to the S&P, but still in a longer term downtrend. Discretionary, this is coming down and testing its 200-day moving average and still in an uptrend, but a lot of weakness. And a lot of this is coming from Tesla. And that's why this ratio is going down as Tesla's been under pressure. And we look at correlations, we look at stocks to the dollar, and we see that the correlation is pretty strong right now because both are going down. That's why this ratio has been, or this correlation has been going back up. When we look at the S&P to oil, both have been going down lately. So the correlation is pretty strong. And then stocks to the 10-year yield coming back down and starting to get more neutral where they had been going in the same basic direction. And then tech to the 10-year yield also in the same direction, but now starting to come down. And stocks to the 2-year yield still having a slight tendency to go in the same direction at the same time. As the 2-year yield was coming down, we were seeing the S&P coming down as well. Then some long-term charts here. This is a monthly chart of the NYSE. This is still holding up fairly well, but we're seeing some weakness coming in here with the Kopic curve. This is a long-term momentum oscillator since it's a monthly chart. Here's a daily chart of the NYSE where we've been seeing a little bit of weakness, but it's been holding up better when we look at the NYSE record high percent index. And here's a monthly chart of the S&P 500 coming down and testing a very long-term moving average. Now, this is a monthly chart, so this moving average is based on 12 periods. This could be long-term negative if we end up dropping below the moving average. But we're seeing the percentage price oscillator, the PPO, showing some weakness now. Then we look at the S&P on top, which is coming down to its long-term moving average. And now we're seeing a rollover as stocks are starting to underperform commodities longer term. Then here's another global look with US stocks starting to underperform world stocks. But the KST is still positive, but it is beginning to roll over. That's a long-term momentum oscillator. Then here's the positive side, and then the next slide will be the negative side. When we look at growth and value by themselves, they're in uptrends. It's just when we're seeing a little bit of a shift when we do ratios between the two. Copper has now been added back to the positive list. And we still have the dollar, even though it's been getting just hammered over the last week or so, it's still in a longer term uptrend. CRB index, gold, and silver are all in uptrends. The mega caps, FANG index, ARC, the low volatility ETF by itself, staples, the Dow Jones Composite Average, bonds based on price, the tech sector, high leverage loans, the Dow, the NYSE Composite, and Wilshire, the NASDAQ and NASDAQ 100, mid caps, small caps, and micro caps. Now, if we start to see follow through weakness, this list could get quite a bit shorter. All stocks are still in an uptrend, as are emerging markets. Bitcoin is still in an uptrend, but can't seem to get above 100,000. Then we have the negative side, and this is when the 50-period moving average is below the 200-period moving average. And the euro, the yen, the British pound, and the dollar. But we've seen a real reversal more in the short term. The semiconductors, and actually the ETF has now switched over to negative. I should have changed that. And the world bond index is still in a downtrend, where all the other price of bonds are in uptrends. And then corporate bonds are starting to see a recent downtrend there. Thank you. I hope you found this helpful. Have a really good weekend, and I will talk to you in the next video.